I think we're going to see one big push where silver goes from where it is right now, potentially busts through that $100 per ounce mark. The question is, where is the peak? When things go parabolic and have these bubble phases and the whole world moves in, you don't really know where that peak is going to be, but the next critical upside target or major target is $106 an ounce for silver. Gold and silver are obviously in a screaming bull market. We got massive volatility in silver, which it's a bit of a warning sign. Obviously, we've seen the margin requirements change on silver a couple of times. That created a bout of selling in the precious metal space, which so many people argue that markets are manipulated and they're getting hammered down. But really, to me, it's a margin call, margin requirement. Whoever's long silver, for example, probably has gold, probably has platinum or palladium, or they have to liquidate, trim their portfolios and raise cash to meet margin requirements. So these sharp pullbacks are nothing more than just a news-driven event. $5,100, $5,200 per ounce level for gold, which at the current price, that's about a 15% move from where we are right now. Well, there's a lot going on, but there's no doubt the best asset right now is the silver, for more or less the silver ETF or the price of silver. We've seen silver skyrocket higher based on our BAN, which is our best asset now strategy, as you mentioned. We had a new trigger in silver, in SLV. And of course, we're seeing this thing rip to the upside, just screaming, breaking out as you and I are speaking today. And I mean, this is a high momentum move. Really, metals is where all the money is flowing. The stock market has been dormant and chopping sideways for a couple of months, not really getting a lot of traction. And so all the focus has been on metals. And pretty much, if you look at our hot list here on the left-hand side, silver's number one, copper's number two, silver miners, then base metal miners and GDX, lithium. So we definitely have, the resource space is on fire. It's breaking out. We got massive volatility in silver, which it's a bit of a warning sign. I'm going to flip over to the futures chart here, the daily chart of silver. And this type of volatility that we're seeing over the past week and a half is pretty extreme.
Silver isn't leading because it's exciting. It's leading because capital has quietly abandoned stalled equities. As Chris Vermeulen points out, while stocks have gone sideways for months, metals are absorbing fresh inflows, and silver volatility confirms aggressive positioning, not retail speculation. When an asset tops a best asset now list alongside copper and miners, it usually reflects fund rotation, not headlines. Historically, silver volatility above short-term averages often precedes either explosive continuation or violent shakeouts. Both matter for risk sizing. Investors should recognize that momentum phases reward discipline, not blind chasing. What Chris Vermeulen highlights next explains why this volatility may be more signal than noise.
When we have these 10 to 12% back and forth days, that is a sign that a lot of people are moving in. There's big bouts of buying and selling, and volatility tells us that something big is about to happen. Now, usually when we see elevated volume and volatility, it usually means a turning point is coming. But at this point, we're still in a high momentum phase to the upside. All the moving averages are sloping upwards. And this is a high momentum move. We could actually see silver have a very big move based on the Fibonacci theory. We have a huge upside target in silver based on this rally that points to roughly $106 an ounce if this was to pop and explode. And that means we could actually see this happen within really just a couple of weeks. I think we were in this very close to this parabolic phase in the stock market where we start to see things really take off and rally. And as you and I have kind of shared before, when we look at the type of price action, I believe gold and silver are obviously in a screaming bull market, but I do think we're coming into this market euphoric phase.
Parabolic targets sound convincing right before volatility flips from friend to enemy. As Chris Vermeulen notes, 10 to 12% daily swings signal institutional activity, but historically they also mark late-stage momentum when positioning becomes crowded. Fibonacci extensions like $106 attract attention, yet past metal cycles show these projections often overshoot before sharp retracements. Moving averages pointing higher confirm trend strength, but they lag reversals by weeks. Investors should separate technical potential from probability, especially as euphoric language replaces risk discussion. What Chris Vermeulen flags next is where momentum traders usually get caught leaning the wrong way.
I think we're going to see one big push where silver goes from where it is right now, potentially busts through that $100 per ounce mark. Gold probably flies up to 51, 52. Who knows where the peak is, but we're definitely in this territory where volatility is here. We could have 10% moves easily on a daily basis. And, this is where all the money is really focused. It's not just like North America, kind of like miners are more of a speculative play. It is somewhat of a focused group of investors. Precious metals, as I've been mentioning on here, you and I have talked about it for many months. I like physical metals better because they're not part of the stock market and they're more global. We're seeing the whole world participate in precious metals. And of course, it's such a tiny, asset, market size. So it moves very easily. So we're in this, I think, this last push to the upside in precious metals. But the question is, where is the peak? And when things go parabolic and have these bubble phases and the whole world moves in, you don't really know where that peak is going to be. But the next critical upside target or major target is $106 an ounce for silver, which is pretty exciting.
Global participation sounds comforting, until liquidity disappears just as fast as it arrived. Chris Vermeulen emphasizes physical metals precisely because their market size is small, but that same feature amplifies both upside and downside volatility. When the whole world moves into a narrow asset class, daily 10% swings stop being hypothetical and start impacting portfolio stability. History shows parabolic commodity moves often peak amid maximum confidence, not fear. Investors should weigh allocation size carefully, especially if metals already dominate recent gains. What Chris Vermeulen explains next reframes why price excitement often masks peak risk.
I mean, I'm just like this because after all these years, that just seems so, outrageous. But so does 80, right? I mean,
Yeah.
We were just at 54 back in the middle of October, not even 90 days ago.
Mm-hmm.
And that seemed, oh, wow, it's broken out to new all-time highs. And 54 to 80 is another 50%. So anyway, it is a remarkable time to be alive. But as you know, one thing I'll point out for everybody watching, because people think, gold's getting so expensive and silver's getting so expensive. And I just always like to remind people, it's not, the gold doesn't change. The gold is the gold. The gold is a measuring stick. It's just taking more and more dollars to acquire that ounce of physical gold that Chris mentioned. It took $1,100 to buy an ounce 10 years ago. It took $2,200 to buy an ounce 5 years ago. It takes $4,400 to buy an ounce now. You can clearly see the trend in the devaluation and in the loss of purchasing power, because the gold is the gold.
Rising gold prices don't prove wealth creation. They expose currency erosion hiding in plain sight. As Chris Vermeulen highlights, gold hasn't changed, but the dollar's purchasing power has halved roughly every 5 years, a pattern consistent with CPI-adjusted money supply growth since 2020. A move from $1,100 to $4,400 an ounce isn't speculation, it's monetary math. Media frames this as expensive gold while ignoring declining real wages and savings. Investors should treat metals less as trades and more as balance sheet insurance. What Chris Vermeulen says next connects this trend directly to long-term portfolio survival.
And with that, let's look at gold.
Mm-hmm.
Because again, long-term, own it, protect your net worth. It's a great physical asset with no counterparty risk. But in the short term, we've got to monitor the price, because if you want to buy some at the most efficient prices you can, you obviously want to buy it on a dip, not at a high. What do you see there, Chris?
Yeah, I mean, not much has changed from our last monthly view of gold. The same targets, the same everything is still presenting itself, where this big run up and push is still pointing to that $5,100, $5,200 per ounce level for gold, which at the current price, that's about a 15% move from where we are right now. So the big picture hasn't changed. And I think that's the key, is you got to stick with the underlying longer term trend if you're an investor and you don't want to get shaken out. There's been some pretty big volatility, some pretty big down days in gold, but it's really kind of most of these moves have been news driven.
The calm part investors miss is that volatility doesn't cancel a trend. It tests conviction. Chris Vermeulen frames this as a long-term structure, holding firm despite noise, with a projected 15% upside still intact near the $5,100 to $5,200 zone. What matters is the price swings are news-driven, not trend-breaking, which historically shakes out short-term traders more than long-term holders. Physical gold's lack of counterparty risk becomes relevant exactly during these volatile windows. For portfolios, this argues for patience over precision, because mistiming re-entries often cost more than enduring drawdowns. And what Chris Vermeulen highlights next reframes how investors should treat pullbacks.
Obviously, we've seen the margin requirements change on silver a couple of times. That created a bout of selling in the precious metal space, which so many people, argue that markets are manipulated and, they're getting hammered down. But really, to me, it's a margin call, margin requirement. If margins go up, there's going to be a bunch of margin calls. It's going to force a bunch of people to have to sell, and that drives the price down. And of course, usually, we saw it across the board in gold and platinum and palladium. And, whoever's long silver, for example, probably has gold, probably has platinum or palladium, or a good group of them. And so they have to liquidate, trim their portfolios and raise cash to meet margin requirements. So these sharp pullbacks are nothing more than just a news-driven event you could say it's trying to shake the market out, but really, the COMEX trying to balance things and try and keep some margin and investors a little bit protected. If the SEC or the governments really actually are there to protect the people.
The uncomfortable truth is that forced selling often looks like manipulation when liquidity dries up. Chris Vermeulen consistently points out that margin hikes mechanically trigger liquidations, and history shows these events ripple across correlated assets, not just silver. When leverage meets sudden rule changes, price drops are automatic, not conspiratorial, as seen repeatedly during past COMEX adjustments. Investors holding multiple metals are pushed to sell quality assets just to raise cash. That's a structural risk Wall Street rarely explains, especially to retail participants. Chris Vermeulen warns that what follows these washouts often surprises investors who panic too early.
But anyway, gold is definitely still pointing to higher pricing, and I think it's going to continue to grind higher, and I think it's just a matter of time before it picks up speed and hits all-time highs again. And then we start to, I think this next run could be very, very exciting. 51, 5,200 is the next target, but who knows where the peak could be. We could see this, go dramatically higher. It's just a matter of how things unfold, and I just measure the markets one wave, one move at a time. A lot of people will start stacking up, a 200% move or 300% move based on Fibonacci or other patterns. I don't do that because they're not very accurate. I like to just go one leg at a time, and you stay invested because you follow the underlying trend. And that's kind of what I think most precious metal investors do. They buy and they hold it, and they stick with the underlying trend here.
Big forecasts feel exciting, but discipline is what compounds returns. Chris Vermeulen emphasizes measuring markets incrementally because multi-100% projections often fail under real liquidity conditions. Historically, sustained bull markets unfold in waves, not straight lines, and chasing Fibonacci extremes often leads to mistimed exits. Staying invested through confirmed trend legs reduces emotional errors and transaction costs. For long-term portfolios, this approach prioritizes survival and consistency over prediction. Chris Vermeulen's next point quietly challenges how most investors think about upside targets.
An underlying trend. Let's for those folks that don't watch us every month, which why wouldn't you? But if you don't, we've often discussed the weekly chart of gold. You want to adjust that to weekly and show everybody how gold just keeps moving up in these 20% rallies followed by consolidations.
Yeah, I mean,
kind of pull flags along the way.
Yeah, whenever we look at this market, I mean, there's been a series of, 20% rallies. There's another one here. There's another one here. There's another one here. I mean, it's just never ending 20+% rallies, right? And from kind of the middle of this range to the next one,
which
I
is
need
5,100 or 5,200.
I don't know where it is, but it's probably pretty darn close. Let's just grab in the middle here and go up. Yeah. So it's just a series of these waves. The market, takes the staircase up, as most people hear, and then the elevator down, right? So it's just a matter of understanding how the markets move. And if you look at these moving averages, which is the 150 period, the 50, the 20, and the 5, they're all fanning and sloping up. That's a very good sign. When you zoom out on the charts and you look at the big picture, it is starting to look a little, parabolic in terms of the price action when things start to go straight up.
Repeated 20% rallies aren't randomness. They're a structural rhythm. Chris Vermeulen highlights how rising moving averages across multiple time frames confirm trend strength rather than exhaustion. Historically, stair-step advances reward patience, while sudden drops punish leverage and late entries. Parabolic behavior only becomes dangerous when breadth collapses, something charts don't yet show here. Investors should recognize that consolidation phases are where positions are built, not headlines made. Chris Vermeulen's next observation explains when this staircase finally breaks.
But there's nothing you can do about it. When something's in a strong trend, you gotta ride the trend until it proves otherwise. And who knows where this peak will be in gold once this wave kind of comes to an end.
So when you're, as you always describe your service at thetechnicaltraders.com, you identify with the best asset now. And then your subscribers, the members of your business and your site, are able to follow your trades. So when you're trading things like gold and silver, are you using the big ETFs? Do you have a couple of favorites that you like?
Yeah, so we've been trading, and we're long currently the Sprott Gold Fund, PHYS. We've traded that a couple of times. We're long it right now. Let me just pull that up. So yeah, I mean, obviously, there's a lot of stories out there about some of the other physical gold ETFs. Do they have the gold? All that stuff. And I mean, I trust Sprott. Sprott's, one of the most trusted names.
The quiet risk here isn't gold's direction. It's where investors choose to express that exposure. As Chris Vermeulen points out, strong trends demand participation, but structure matters just as much as timing. FIS appeals because it reduces counterparty uncertainty, a concern that resurfaces whenever ETFs face scrutiny over custody and redemption. In past liquidity stress events, trust in structure has mattered as much as price itself. For long-term investors, this is about removing hidden fragility, not chasing returns. What Chris Vermeulen emphasizes next explains why ETF selection can matter more than entry price.
So this is what we play. We've played this. We've had a couple very nice moves in playing these breakouts and these runs, these explosive moves using PHYS. And that's obviously my ETF of choice. I store my physical metals with Sprott, so it's kind of an easy solution. Just kind of one does it all. One kind of core name and brand there.
And so let's talk about the mining sector because as you mentioned earlier, it seems like a U.S. Canada fixation more than anything else, at least at this point. And a lot of the shares are, they're higher than they were when they peaked out in October, but some on a less percentage than what the metals themselves are. Do you have an ETF that you like to use for the mining sector? And if you do, what does that look like at present?
Yeah, we move around. When we take a look at our hot list, I generally like to follow the GDX. GDX is kind of the one that I track.
Here's the disconnect. Wall Street rarely explains. Metals surge, miners hesitate. Chris Vermeulen highlights GDX as a proxy for institutional appetite, and that hesitation tells a story about capital preference. Despite gold's strength, miners lag because margins, costs, and geopolitical exposure complicate the trade. Historically, miners outperform later in cycles, not at the initial metal breakout. For investors, this gap warns against assuming leverage works automatically. Chris Vermeulen's next insight clarifies what miner underperformance is really signaling.
We can move around to trade different ones, but GDX is kind of the one that we track in terms of, I like to follow the larger caps because it gives me a better view of the tide of big money flows, bigger companies. I like to know if the tide is moving up or down. That's how we follow assets in the market. If something's trending higher, the large group of them, then we tend to follow that. So that is GDX is the barometer to track. And then from there, we just go and we trade whichever ETF or individual gold stock we would want to trade. But when we look at it, miners really have really just broken out of the highs that we saw back in October, and they have had a nice move, about a 30% move up from the lows, but overall they're not extending and ripping higher. You would think with gold hitting all-time highs and silver screaming higher, we would be seeing the miners moving up quite significantly, and they're really not. And I think it's a little bit more of kind of what you and I have talked about for many months, is I think the metal space is kind of where the global money's flowing.
The market is voting, and it's voting for metals over miners. Chris Vermeulen notes that large cap miners reflect institutional conviction, and that conviction remains cautious despite a 30% rebound. When gold hits highs but miners stall, it often signals risk aversion rather than disbelief in the metal. Big money prefers liquidity and simplicity during uncertain macro cycles. For portfolios, this suggests defensive positioning, not speculative excess. Chris Vermeulen's next point reveals where global capital is quietly concentrating.
So from, a lot of countries can't trade in the US, or people can't buy ETFs, and depending on where you are. So we're seeing people just buy the physical. And I think that's, where the big money is. Not so much in the speculative side right now. I think we're seeing silver really break out and run because it's a small market and it's a global market. But the miners, they're still trending higher. I think they're getting ready for another pop and another run. I think we need to see gold break out and have a move higher. And I think that'll bring the miners back into high gear. When we look at this chart, we've seen this pullback. It's now kind of come up here and has created this kind of volatile pause. And I think it's primed and ready for a fairly significant run to the upside. And it's the same with silver miners. When we look at silver miners, we have much of the same type of pattern. SILJ, they move faster percentage-wise, so it's higher on the list. But it's the same. It's just had a very nice pullback.
Global access, not speculation, is driving this phase of the rally. Chris Vermeulen points out that physical buying dominates because many investors can't access US markets or ETFs. Silver's breakout reflects its smaller market size, where marginal demand moves price faster. Miners lag because confirmation from gold's next leg is still pending. For investors, patience here matters more than anticipation. Chris Vermeulen's next observation explains why pullbacks often precede minor acceleration.
In fact, the pullback is what I call like an ABC pullback. You have an A, then you have a B, which is a bounce, and then the C. And the C pullback, it breaks the previous low. That's what creates a shakeout. Anybody who's following it too closely will have a stop set under there. And of course, they get shaken out, which you can see the market flushed down with big volume, and then boom, it takes off and rallies. And it's the C wave, this ABC correction, that cleanses the air or the market, and then it goes higher. We even had the same, when you look at a lot of these patterns, the same thing happens. You have an A, you have a B, and then a C. And it's this little breakdown that shakes people out, and then the market screams higher. And it did the same right over here. A, B, C. Now, this one didn't break by much, but it still made a lower low. It would have flushed the market out, and then it takes off. So we just had that, and now silver miners are starting to run. Gold miners are starting to run. So I think we're on the cusp of, a breakout to some highs for SILJ and for GDX pretty much any day here.
The shakeout isn't an accident. It's a feature of market structure. Chris Vermeulen explains that ABC corrections are designed to flush leveraged and impatient traders before trends resume. Volume spikes at the lows often mark institutional accumulation, not failure. Historically, these patterns precede sharp advances precisely because risk has been reset. For investors, stops placed too tightly become liabilities, not protection.